Uh, Good morning, everyone. We are grateful that you are with us today. Especially, my presentation is on helping our client Ballerina make the right investment decision on what to do with the $10,000 she got as an inheritance. Now, let us discuss two cases like Foodie Private Limited is a retailer supermarket chain and Clothy Private Limited deals in outdoor products. From profitability analysis, efficiency analysis, liquidity analysis, and capital structure analysis, I shall then give a recommendation inclined towards Valerina's objective. Let's dive in. The goal of this presentation is straightforward to compare Foodie and Clothy based on their financial data of the year 2023 and 2024 so that they can make the right decision in investing for Valerinas by comparing which one offers a better return on her investment. To this end, attention will be paid to such financial ratios that will receive the basis, strength, and weaknesses of each company. When this comparison has been done, we will know which uh, company better relates to Ballerina's financial objectives and her emphasis on relatives or absolute profit. Profitability ratio assists us in evaluating the ability or capacity of an enterprise to generate profit in its operation. So to start with, the first gross profit ratio is net profit margin, in which profit is defined as the proportion of revenue. Clothy had a better financial margin position in both the year 2023 and 2024 with 3.76% and 3.31%, and while Foodie has 2.64% and 2.57%. This shows that Clothy has better control over revenue costs. However, the factor of profitability is not the margins only. Return on assets, which expresses a company's ability to generate profit from assets, speaks of a different thing altogether. The organizational performance result inclined that Foodie had a higher return on assets with figures of 5.69% in 2024 as compared to Clothy's 2.39%. Foodie performed very well in ROE as well, particularly with 31.05% as opposed to Clothy's 4.35% in the year 2024. These outcomes annually prove Foodie to better capitalize its resources and equity to provide returns, and scores of profitability analysis prove Foodie to be a superior performer. Thank you.
Hello everyone, I'm going to talk about the efficiency ratio. Efficiency ratio measures the ability of the firm to manage and utilize its asset in the generation of the revenue in terms of asset turnover. We had a higher result while the food is 2.25 in terms in 2024, while the clothing is 0.75. This indicates that the food earns more two times than revenue for each dollar of an asset than the clothing. Going to the inventory turnover, Foodie also had a higher turnover of 12.91 in 2024, which means that the company is efficiency in turning the inventory and converting it to sales. The figure is much lower for a clothing, only 1.56, the same as in the same year, which point out that the clothing is experiencing sluggy inventory turnover. This result more or less minor. Foodie operating the model is high commercial retail company, whereas the clothing deals with a different kind of a market that might the lower stock turnover. Now I'm going to talk about the liquidity ratio. Liquidity is a crucial for understanding a company ability to meet short-term obligation. Clothing earns more than the foodie year. Its current ratio was 1.78 in 2024, still much better than the foodie rather than low 0.59. If the ratio is higher than 1, This means that the clothing has enough current asset to offset the current obligation. The ratio of footy shows that the business essential depend on the cash flow. The same trend is observed in quick ratio, which indicate that the ability of cash when the current asset are converted to the cash and equally clothing 0.65 in 2024 to the food is 0.38. Visibility generate from the cash flow could reveal the higher leverage for the clothing in terms of responding to the unpredictable cost with restoring to inventory. All in all, it can be a state that the clothing has a better liquidity, and this is the less risky in financial insolvency. Now I'm going to talk about the capital structure ratio. The next discussion will focus on the capital structure, which investigate how firm finance their operation. Foodie has over the 4 times in debt to equity ratio in 2024, which means 4.5 over the clothing 0.82. This means that the foodie has a much dependency on the debt funding, which is not good for the business in case condition changes. Conversely, the clothing company ratio depends on safer operating level without depending too much so credit fund. Clothing has the perform better in equity ratio. 54.88 of the assets are the funded by the equity as compared with the free equity ratio of 18.34. This makes that the clothing very safe and a low risk in terms of financial basis, which is in terms of the support to their strategic direction.
Hello, Miss Unicong. It's me, Denish from our accounting class, and I'm here to present the presentation from our assessment week 11. And I'm covering the rest of the parts on the topics like key insights, possible reasons for variation, and the final part, the recommendation. So we're gonna start with the key insights. So let's consolidate this insight. So from this ratio, Foodie has been enjoying good returns on its assets and equity and recorded a very efficient stock control. Also, there are some issues such as low liquidity and high dependency on debt, which cause high financial risk. And especially Clothy stands out with its liquidity and capital structure ratios. High equity ratio and low leverage of debt is in good control, and hence it is financial position sounds good. Its disadvantages includes lower operation profit margin and poor asset turnover to constrain its growth. We're going to talk about the possible reason for the variation. So these differences had to do with companies' business models. Foodie operates in a high volume retail environment and as a result has justifiable levels of volume. So it leads to the creation of revenue profit streams in the business. So however, its use of debt points towards the company's use of aggressive expansion strategies. So Clothy operates as a company that specializes in selling outdoor equipment, which means that the sales are seasonal as well as the inventory turns over at a slow pace, hence the profit is affected. However, it is conservative financing strategy that lets it retain liquidity and avoid financial risks. And while this is a safer and much slower growing option, it is still an attractive choice. In the next slide, we're going to talk about the recommendation part. So in this part, the suggested course of action in the stock acquisition of Fully Private Limited. This one outperforms the other two in revenues, profit, return on assets, and return on equity, leading to efficiency in developing returns. Its reasonable and inventory turnover ratios illustrate that the company had an excellent record in operational efficiency as far as resource and inventory as also concerned. They make fully stable and the right choice where growth is desired in the long run. So on the other hand, Clothy Private Limited produces high liquidity and a relatively safer capital structure with two considerable issue of debt. Still, it cuts profitability and operational efficiency, making it slow to realize the company's opportunity to generate the most profit. So in the so in the most suitable company for investors such as Ballerina aims at staying stable investments with growth prospect, Foodie will be more appropriate for her. Clothing may be suitable for a investor who is more curious and selects the stocks to avoid or minimize losses rather than waiting for a big profit. This is disputing that the result is nothing compared to Foodie's stabilities and prospect for the growth. Hence, my last conclusion, I would like to recommend investing in Foodie Private Limited because it fits into the long-term investment plan.